A few years ago, when I first stepped into the chaotic world of day trading, I was constantly chasing the market. I tried every complex indicator and read every chaotic chart pattern, only to watch my capital bleed away through emotional decisions and low probability entries. Over time, through trial, error, and painful discipline, I stripped away the noise and refined a single, elegant framework, a strategy called SLC, which stands for Structure, Level, and Confirmation. It became the bedrock of my trading, turning random price fluctuations into a structured daily routine. The beauty of this framework lies in its simplicity. It isn't built on secret tricks or magical indicators. It is a decision-making engine designed with one primary goal: to stop traders from taking low probability setups. When executed with unwavering discipline, it naturally eliminates a massive percentage of losing trades, transforming chaotic guesswork into a consistent, systematic approach to the markets. At its core, trading is never about being right all the time. It is strictly a game of probabilities. No analysis in the world guarantees a 100% win rate. Success comes from stacking as many statistical edges in your favor as possible before ever taking a position, ensuring you only engage when the odds heavily lean in your direction. The entire system rests on three distinct phases, beginning with the letter S, market structure. Picture yourself standing at the edge of a fast-flowing river. If you dive in and try to swim against the roaring current, every stroke demands immense effort, yet you barely make any progress. You fight the river, exhaust your energy, and eventually get pushed back. But if you turn around and swim in the exact direction the river is flowing, the momentum carries you effortlessly downstream. Market structure works on the exact same law of nature. Before opening a position, you must determine the high time frame direction for that day. Market structure only ever exists in three states: an uptrend, a downtrend, or consolidation. In an uptrend, price systematically prints higher highs and higher lows, signaling that buyers are in complete control here. You strictly look for long trades. In a downtrend, price creates a steady cascade of lower highs and lower lows, showing sellers dominating the field here. You only seek short trades. If the market is consolidating, moving sideways in a messy range, you simply step back and do not trade at all. Once the macro trend is established, you move to the L, marking your levels. Imagine walking onto a field before a major conflict. You don't aimlessly swing your sword everywhere. You mark the exact high ground terrain where the real battle will take place. In trading, levels are not random lines cluttering up your screen. They represent high probability zones where aggressive buyers or sellers previously stepped in with heavy order flow. When searching for these battlefields on TradingView, we look for supply and demand zones. A demand level forms near the bottom of a move, right before price launches into a violent, sharp rally upward. That sudden expansion proves that massive buying interest flooded the zone in the past. If price ever returns to that floor, there is a strong probability buyers will step up to defend it again. Conversely, a supply level forms near a top, right before price plummets vertically downward. That aggressive drop marks strong institutional selling pressure. If price rallies back into that ceiling, sellers are very likely waiting in ambush. The final piece of the puzzle is the C confirmation. When price reaches a well-defined supply or demand level, you never enter blindly. Levels are not magic walls. Price can easily blast right through them if market sentiment shifts. Confirmation means waiting for specific price action triggers or technical signals that prove buyers or sellers are actually defending the zone right now. This patience protects your capital from false breakouts and keeps you on the right side of the move. To see how this plays out in real life, visualize opening TradingView and loading up the 4-hour chart for NASDAQ futures. As you look at the screen, a clear story unfolds. The candlesticks are steadily sloping downward, printing a clean sequence of lower highs followed by lower lows. The current is undeniably moving downstream. The macro structure is bearish. This tells us immediately that for the rest of our trading session, we will strictly align ourselves with the bears and hunt for short setups. With the macro direction locked in, you drop down to the 5-minute execution time frame to map out your battlefield. Scanning the recent price action on TradingView, your eyes look for moments where price dropped violently. You immediately spot two distinct zones where heavy selling pressure entered the market. The first is a sharp downward displacement slightly lower on the chart, and the second is a crisp, aggressive sell-off further up. To mark these supply zones, you select the last bullish candlestick right before each sharp downward move and draw a horizontal box spanning its high and low. These two highlighted rectangles are now your designated battle zones. If price wanders anywhere outside these boxes, you do not touch the market. As time advances on the chart, you watch the candles form. Price begins to push upward and hits the first, lower supply zone. Instead of pausing, a strong green candlestick blasts right through the top of your box. A novice trader might panic, wondering why a strong supply zone failed to hold. But understanding market dynamics keeps you calm. Supply zones simply mark areas where heavy selling occurred in the past. They are not absolute guarantees of a reversal. This is precisely why jumping in the moment price touches a level is a fatal mistake. Without waiting for confirmation, you would have been caught in a losing trade. Since this lower supply level was broken to the upside once, its dynamic changes. To consider trading it in the future, you would need to see price drop cleanly back below the zone, retest it from underneath as new resistance, and offer a strong confirmation signal. If price simply chops back and forth through a zone multiple times, it becomes completely invalidated and must be erased from your chart. Now, your attention shifts to the upper supply zone. This level remains completely fresh and untouched, a prime area for potential short trades. You watch closely as green candlesticks steadily climb higher, slowly retracing straight into this upper supply box. Instead of rushing to enter the moment price touches the lower boundary of the box, you turn to your confirmation tool on TradingView, the stochastic oscillator, tuned with customized parameters to track momentum shifts. You need to see two conditions met simultaneously: price tapping into the supply level, while the blue stochastic line crosses above its upper threshold and then aggressively hooks back down. This sequence tells a clear story. Buyers pushed price to an overextended state inside a heavy supply zone, and now momentum is rapidly shifting back to the sellers. Interestingly, if you look back at an earlier shadow where price briefly spiked toward this zone, the blue stochastic line crossed above its upper boundary, but it failed to cross back down. The momentum never flipped. That absence of confirmation kept your hands off the trigger and saved your account from a premature entry. This time, however, as price touches the upper box, the blue stochastic line breaks above the upper threshold and cleanly crosses back down. The confluence is complete. The 4-hour macro structure on TradingView is bearish. Price has retraced directly into a fresh, high-probability supply level. The stochastic oscillator has confirmed a clear momentum shift back to the downside. With all three conditions satisfied, you execute a short trade without hesitation. You place your stop loss safely, slightly above the top of the supply zone, to protect your capital against unexpected volatility. And you set your take-profit target at a 2-to-1 reward-to-risk ratio. As the next few 5-minute candles print, price hesitates briefly at the entry before red candlesticks begin to expand downward. The supply zone holds firm, sellers take complete control, and price glides smoothly straight into your take-profit target. When you replace emotional reactions with a strict checklist of structure, level, and confirmation, trading stops feeling like a high-stress gamble and becomes a calm, repeatable business.